Passive versus active investing. We've gone through some steps showing you how to invest in the stock market, choosing individual stocks. But this activity may not be for you. You may be a passive investor. There are a lot of conversations about what type of investing is better, passive or active. I'm going to show you what the difference can be between passively investing or being an active investor. Regardless, I highly recommend one of the two. Let's look at passive investing first. Investing $18,700 in the S&P 500 as a passive investor in November 2019 would have bought you 60 shares. That would have cost you $305.94 for one share. In 1 year, you would have made 7.9% in the profit. If we was to combine this being a passive/active investor, investing the same amount as a passive active investor, but instead of putting all the money in the beginning, you would be putting money every single month for 12 months, still totaling 60 shares. In this strategy, you would have made 6.09% profit. That's adding 5 shares each month. Active investing. Investing in the S&P 500 as an active investor, putting money in when the market dips only. That means 15 shares bought each time the market dips. In total, you would have made 15.56% profit. Here's another scenario as an active investor. Investing in the S&P 500 again as an active investor, buying more shares as the market drops. In total, you would have bought 16 shares altogether, and you would have made 25.88% profit in a year. So you can see by the chart here that each time the market dips, you do not put in the same amount of money. You put in more money as the market dips. And as the market comes back up, you put in less money or buy less shares. Let's look at each scenario in more detail. So putting money in the S&P 500 as a passive investor, buying 60 shares at once in November 2019, would have cost you $18,356. The average share price would have been $305.94. Again, 60 shares. At the end of the year, end of November 2020, the share price was $330.11. That is the total profit of $1,450, 7.9%. As a passive investor, you're unable to outperform the index that you're in this case the S&P 500, because you are putting your money in at once and just relying on it to go up over time without any interaction. Scenario B, being a passive and active investor. What does this mean? So, investing in the S&P 500 as a passive/active investor, putting in money in every month for 12 months, okay? Buying the same amount of shares. So, how much would you have put in total in that year? You would have put in $18,669.95. The average share price would have been $311.17. Again, total 60 shares. At the end of November 2020, the share price is $330. That would have given you a profit of $1,136.65. That's an increase of 6.09% return. Scenario C, being an active investor. Investing in S&P 500 as an active investor, but you're putting money in every time the market dips. But you're putting in the same amount, so you're buying the same amount of shares each time. In total, you would have bought 60 shares. You would have spent in total $17,139.9. 60 shares, as I said. And obviously the price at the end of November 2020 will be $330.11. Your profit here is much better. is 2,666.7, and the uplift, the percentage growth of return, is 15.56%. Scenario D, you can call this active investing plus. So investing in the S&P 500 as an active investor, putting in money in only when the market dips, as before. But in this case, you're putting in more shares or buying more shares as the market dips. So the lower it dips, the more shares you're going to buy. So if you look at this example here on this chart, so in November, 15 shares were bought. It dipped pretty low in March 2020. 30 shares were bought. That was the biggest dip. In June, it was going back up. 10 shares were bought. In September, it was going back up even more. Only 5 shares were bought, still totaling 60 shares. You can see the total amount that was invested is pretty less than the other scenarios. So that is $15,734.80 to be precise. And the average share price is much lower as well, because what we have done here in this scenario is actually bought more shares at a lower price. So therefore, the dollar cost averaging kicks in. So the more stock you buy at a lower price, the cheaper your overall share price will be. Okay. So in November, the share price was $330.11. And that give us a total profit of $4,071.80. A total uplift in percentage wise is 25.88%. So let's have a quick look and review these different strategies of investing. Strategy or scenario A, passive investing. 60 shares bought in one go. This is the total amount, 18,356. Total profit, 1,450. Uplift, 7.9. Scenario B, passive/active. So, bought equal amount of shares each month. Okay, so that's buying shares every single month and the same amount each month. Total invested is 18,669.95. Again, 60 shares bought. Total profit of 1,136, 6.09%. Scenario C, active investing, only investing in equal amounts, but when the market dips. So putting in the same amount each time, but when the market dips. Total invested, 17,139.9. Again, 60 shares bought. Profit, 2,666.7. Uplift of 15.56. And scenario D, active investing, only investing when the market dips, but buying more stock the lower the market drops. Okay, so the total amount invested is much lower than all of the previous ones, but the total amount of stocks is the same. So 15,734.8, there's a total amount invested, and the profit again is a whopping 4,071.8. An uplift or percentage growth is 25.88%. Now that you have seen the numbers, putting the work in as an active investor can pay off. However, if you haven't got the time to analyze stocks and companies, investing in indexes or ETFs may be better suited for you. Please note that investing is better than not investing at all.